We're back. Did you guys miss us?
I didn't
It's
miss
Bill, Wendy, and Jonathan with Carolina Capital Management. So we're again going to be talking about the numbers this month, and we're going to do a little overview on numbers when it comes to fund investing right after this.
Woohoo!
I guess I don't have to say who we are anymore because our graphics do it for us.
That's right.
Isn't that sweet?
It is. It's
nice.
pretty cool.
Thank you so much for joining us on the Passive Accredited Investor Show. We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget to sign up with Wednesdays with Wendy.
I feel like I should be playing.
And I'm pretty sure that that's not copyrighted material.
I love it. I love it. That's so cool.
So Wendy gives up 30 minutes per person every Wednesday to talk about anything real estate. There's the link to her calendar. Sign up as soon as you can. By the way, we have a comment or question section over
Chat box.
on the right side. Yes.
Chat box.
That's fine. That's fine.
It's on the right side of your screen or underneath, depending on the platform.
Probably not above.
By the way, there's also in there in the chat box already a link to wisewomenexpo.com.
That's
You wanna
right.
talk about it, Wendy?
That's right. Wise Women
Wait a
Expo.
minute. We have a little commercial about it, I think.
Oh, we do?
Or a little graphic.
Awesome. It is a virtual. In fact, what's so cool about this, Tracy Rui and her husband Fred are the ones who started this virtual lessons, virtual events long before COVID hit. That's what was so cool about it. They did it long before COVID hit. I remember when we did our first one with them as a group. It wasn't called Wise Women. It was another one that they do that's excellent. And I was amazed at how many people came to that. It was, thousands that showed up for this event that was online. I was like, wow, this stuff really works.
It was easy for them to show up.
That's right.
They only had to go to their
That's
desk.
right. So they're like, they're out in the front runner of knowing how to get these kind of things done. And the Wise Women of Real Estate is really good. It's not just for women, although the lineup is all female. The speakers are incredible. You've got Liz Faircloth. There's Tracy Z on it. Liz Faircloth also has this thing called investher.com, which is really cool. Mary Hart's on there. Just really good folks that know what they're talking about. Lots of different topics, like anything you can imagine. Darlene Root is a speaker. She was in our mastermind. She's a sharp chick as well. And it's it's a female lineup, but a lot of men attend this as well. It's really, really good. So you can do it online, October 22nd and 23rd.
Killing him.
It is. He's just trying. I'm just going to keep talking. But anyway, you can sign up for it and get a ticket for it. So tell all your friends.
Yeah. So then I was going to say, if you think you have nothing to learn that you like from or anything, these women are phenomenal. And I think a lot of males who suffer from probably chauvinism,
Pigness.
They think they have nothing to learn. And the thing is, like, these women are ahead of the game in so many aspects.
Yeah.
They are combining different components of real estate and other aspects that you would never think about doing, and they're making them successful.
That's right.
So it's
all while raising children.
Yeah. Well, it's well worth your time to figure this, sit in there and figure these things out, because they are blazing the trail on new and exciting things in real estate.
Yeah. Well said, Jonathan. Thank
Oh,
you.
And I was going to say the information could be identified in any gender. It doesn't really matter who's delivering it,
Yeah. Well.
right?
So you would say the information is non-binary?
Yes.
Okay, got it.
Wait a minute.
It identifies as a female
Binary. Isn't that a code?
event, but any gender can enjoy it.
That's correct. I keep getting out of the screen. Sorry.
Well, we'll keep pushing you. That's
Yeah. So the numbers is what we're
yeah.
going to talk about.
Yeah.
Bill, this is really your forte, isn't it?
Well, no, you're in there as well. So,
I'm sorry, I shouldn't have laughed so hard when he said that.
again, we're focusing in on the numbers this month, and I just want to kind of give you an overview of investing in private placements, the different types of private placements, what numbers are important to you, depend on where you are.
I would really like to preview this though, and say this about numbers, although I hate them.
You have to count them.
You have to know them to be successful and understand what it is you're doing. Once we really got our arms around all of our numbers and what we were doing, our business just exploded. Number one, I mean, we grew exponentially from once we really got our arms around it. The other thing that's really cool about it is now that we really know and understand our numbers, and I hate to use the word manipulate. That's not what we're doing. We're not manipulating anything, but we know timing of things that need to be accomplished, the deadlines that need to be met that will really make a difference on how those numbers turn out. There's so much more that you can do once you understand your numbers and how they work, how you can make them even better. And just be a better, stronger company for it. Whether you're a single person or a big company, your numbers are important.
Well, the old adage is 100% true. If you can't measure it, you can't manage it.
Well said.
And it's 100% true. So once you begin to be able to measure things, you can then manage them. And like you said, it's not manipulating, it's managing. It's knowing, do I sell this tranche of notes before this level of rehab is allocated out?
Right.
And what does that do if I do one or the other in different sequences? And knowing how those play together allows you to control and say, hey, I want to, it lets you back into your number. I want to solve for X being the return we want to get.
Getting the best you can get.
And then holding that as our constant, and then not manipulating, but managing everything over here to make sure that we still get out to this number.
Yeah. Excellent.
Well, that being said, if you want to go over to the stock market type of forecasting, most companies have to do their business based on each quarter, their earnings season, because if you don't post the proper numbers at that quarter, then your stock prices go down.
Yeah.
Right. The visionaries, however, they have to think 5-10 years in advance. And it's very difficult when you're a publicly traded company to think strategically long term, because it's going to affect your stock price short term.
Right.
And you have investors out there in the public that get really mad
on the short term.
Yeah. And
but we need to think
I know
long
I
term.
congratulated the owners of or the people with Home Depot, because they are one of the companies that think long term.
Yeah.
And they just say, the heck with it. I'm not worried about the short term stock prices. We're thinking long term.
Right.
And you have to give them credit for that. So you put that back to our fund in particular. If we're doing things, selling loans, selling properties that we own because the loan went bad, and how that is realized within the fund within a quarter, you still should think long term, because even though if we don't get it done by the end of the quarter and the numbers show a little bit less, it'll be made up in the next quarter.
That's right.
So thinking short term should not really come into play.
Right.
But at the same time, you don't want to freak people out. Everybody looks at their statement it's funny, monthly,
and quarterly. Yeah.
even though they only report quarterly, they look at them every month. This hasn't changed.
Yeah, that's right. It hasn't.
Scott put the question, what is a private placement?
Yeah.
Do you want to touch on it, or you want me to?
Go ahead.
Private placement.
I talk all the time.
Yes, you do.
Private placement is just an opportunity that is not a publicly traded or government backed opportunity. It would be like our fund is a private placement. It is an opportunity to invest your money into a privately held, what would you say? I guess privately held, not
Fund.
Syndication, but fund. Yeah. So that's all that is.
So privately held investment.
Yeah, private. That's the word I'm looking for.
And
Thank you.
there's a lot of companies, and this is where you're getting a lot of pushback from. I forget what the heck they're called now, but there are these groups of funds that will go in, and instead of offering an IPO, they'll go in and fund these companies.
Initial
Initial public offering is what
yeah.
you would have if somebody wants to trade publicly on the stock market. But they have these funds now that they'll take money from investors, and they give you a criteria on the types of companies that they are looking to fund. They don't have it yet. You're just hoping that they're going to find the proper companies, and then they go in and buy these companies before they ever get a chance to get on the open market. And that's also a private placement because they're limiting who the investors are. The thing that the reason it's called a private placement, and you have to qualify to get in them, is because the SEC wants to make sure that your financial knowledge is great enough that you know what you're doing.
Because the government
you know what
knows
you're
better.
getting into. And then number two, if your financial knowledge isn't that great, because one of the certifications is you have to have $1 million in net worth, not counting your primary residence, is that you're not losing your last dime in this investment.
Right.
That you can afford to lose money if you don't have the financial wherewithal to understand the investment that you're getting in.
But don't worry, guys. Gambling is still legal, so you can still do that if you
and lose as much as you want.
You can't lose money
That's
investing it. You can't do that.
That's right.
But you want to go to Vegas and
go right
put all
ahead.
your money on red 32? Okay, sure, go for it.
Well,
so true.
There's a lot of
so true.
There's a lot of stock picks that are the same way, right?
Love it. Yeah, absolutely.
Look at venture capitalists.
Yeah.
They invest in multiple companies, hoping that just one
will pay off and
pays
it'll cover
off.
up the rest. Yeah. You mentioned looking, further in the future, not being so, driven by the quarter.
Short term, yeah.
Yeah. And it reminded me of, it was actually Jeff Bezos that said this, and, was talking about how you build a company, and people always ask him, well, what do you look to build your company out? Like, how do you know what's going to change? Like, how do you do that? And I think his response was, in a nutshell, it's like, that's pretty much not, I get asked that all the time. That's not the interesting question. The interesting question is, what's not going to change? And that's when you want to work with people who are long-sighted. They are building something around like the fundamentals of things that won't change or that have a slim possibility of changing.
Yeah.
And that's assuming we don't get any changes in the IRAs. That's what we're trying to do here is work around a proven model that changes slightly, but not a whole lot. And you can build a long-term portfolio or income based off of that.
Right. And like in our, what we invest in, our fund puts money into, they're short-term loans. So people would say, well, is that long-term thought? Well, yeah, it is, because the way we love our short-term loans, the reason why we love our short-term loans is because we have the ability to right the ship should anything happen outside the market. And gosh, do things happen outside the market? Yes, every day. So we like the ability to be able to change whatever direction we're in. Because we're in short-term loans, we can easily do that by changing our products. And
think about, like, we switched from higher end properties to more affordable
made a
properties.
huge difference.
And then also this year we have not really switched, but because our loans are such short term, we were able to allocate more money into emerging opportunities like new construction, storage facilities, apartments, industrial conversions, stuff like that, because fix and flips, there's not as many as there used to be.
That's right.
But if we were in longer term stuff, we wouldn't have been able to correct that in such a short time period.
That's right. That's right. It makes a huge difference for us.
Well, investors, and in this case, we'll make the jump over, or the leap over to borrowers. A borrower wants certainty long term, and the problem with the companies are you're locking yourself into a long term contract,
right,
where things change over time, and you need to have that flexibility to be able to maneuver based on the new information.
That's right.
So what banks have done, typically commercial banks, on the commercial side, is that you always had to have a balloon in those loans. Or
an
back in the day, because I've been doing mortgages for a long time, back when they first invented electricity. We had a
was that when they were fighting over alternating current versus correct?
we didn't have balloon notes. We had call option notes.
Yeah.
Where
every 5 years
or 3, you can set it up anytime, any way you wanted to.
Yeah.
But at the end of a certain term, you had the option as the lender to call the note due, modify the note in case the rates went up, or leave it the same.
Yep.
And that way it protected the lender from market changes.
Right.
And at the same time, you're not really telling the borrower that they have to requalify for the loan.
Yeah.
Now, again, they still have the option to call it due.
I'm not seeing those kind of loans out there anymore. Are you?
I did one of those about 5 years ago, and that's the last time I've only done one, and it was.
Well, I think it's a great tool. And
it
still should be out
there. It is a great tool.
People aren't using
it. They'll probably come back. Well, because everybody's doing what everybody else is doing right now with the non-qualifying lenders out there. They have to compete with each other because those rates are so good. And
rates have been falling for so long. I mean, a call option. Now, there's other reasons to do a call option besides just an interest rate adjustment. There's all kinds of things that can happen in the market. But the rates have been going down for so long, I think from the interest rate side, it probably didn't make sense to do a call option. Now that we think the forecast is
to go back up,
they're going to go back up, I think they're probably going to make a lot more sense for a lot of people.
But unfortunately, it seems like the lenders that are out there, the big popular strong ones, are the last ones to make the changes. Doesn't it seem that way?
It's hard to turn a cruise ship.
You're right.
Well, here's another
You're
thing.
right.
They've been talking about changing the index for the ARMs for how long?
You mean from having it depend on one measurement to another?
Yes, because
like
the
from the
LIBOR was manipulated, 10 years ago?
Yeah.
Yeah.
Maybe even longer than
that. Are
that.
they still using that?
Everyone's still using the LIBOR.
Not everyone, but most, pretty much all. Well, most of them.
Not everyone, but all of them.
Most of them. They use that, or they'll use Prime.
Yeah.
One or two.
My problem with them still using the LIBOR is at some point they're going to be forced to stop using it.
Yeah.
And if any notes they currently have in place
are being manipulated,
are going to have to change.
Yeah.
Well, they all have it in there. It's LIBOR or the
So
next index that the lender chooses.
Yeah.
Right. But yes, it takes them a while. And I know we were supposed to be talking about the numbers in.
Well, let's do it. Let's still do it. It's not too late.
Again, when you're looking at a fund, it depends on where you are in your investing, what it is you're looking for. If you're looking for income, are you looking for growth? Are you looking for a tax
shelter?
No, you don't say tax shelters.
Credits?
There are no tax shelters. If you're looking for tax help.
Tax help.
If
tax
you're looking,
offsets.
That's exactly what I was going to say. If you're looking for some sort of depreciation or write-off to offset other passive income? Or do you have a place to put your self-directed retirement account where the taxes aren't going to be affected?
Yeah, and that's another thing that's really important is what kind of cash are you using? Is it real cash? Is it
Monopoly?
self-directed money? Monopoly? Self-directed money may be monopoly money shortly if they get away with what they're trying to do. But yeah, I mean, even where your cash is coming from is really important as to what kind of a fund you should be investing in.
If you have a self-directed IRA, which means you can direct that money into whatever investment you want that's legal, you can put that into a fund, and a fund that doesn't own assets, and that's perfect for an IRA because it can't capitalize on the tax offsets.
That's right.
Because it's a tax deferred vehicle.
Like an apartment building development versus notes.
Yeah, exactly.
If your income or your gain in the fund is derived by taxable income, then it's a perfect place to put a tax deferred or tax exempt money.
Yep.
If it's not, and you would like to have some of those write-offs, then you would invest in something that owns property that has that type of
and then
tax.
The other thing to be thinking about too, that a lot of people just, blow through it and they don't really pay attention is there a life to this investment? Is it a 5-year term? Is it unlimited? Is it an evergreen? And can you compound the money that you put in, or are you going to have to take everything out?
Yeah.
Every quarter.
So like syndications are typically, you get maybe a pref plus an equity piece on the back end, right?
That would be a preferred return.
Yeah.
And in in a fund that compounds your principal, basically, I think we were talking about what example in the fund from someone that invested, I don't know, I think it was like $70,000 or something like that, right?
Is that our parents?
No, that's a different one. But yeah, we had someone that initially, I believe, put $50,000 in our fund, and after how long? 5 years?
It was in 20. Yeah, it was the end of 2015, first of 2016. So right about 5 years.
Yeah,
it had doubled, right?
That I am talking about our parents. We had a 13.75% return because it was compounding over time.
Yeah.
We had another one that was it got in a little bit later, but that return was almost 10 3/4 as well.
Yeah. So if you don't understand compound interest, after what was it, 4 or 5 years, whatever it was 13.75.
Sure.
If they keep it in there and the fund,
they keep their dividends in there, not dividends.
Yeah, they keep their principal and their distributions go back in, then that 13.75 just keeps getting bigger. It doesn't so it'll turn into 15%. Then at some point, if you keep it in long enough, it could be a 20% return.
That's right.
It's the opposite of paying your extra principal to your loan if you're borrowing.
That's right.
Because you're only being charged interest on the outstanding balance. And in this case, when you're compounding, you're being paid on the compounding, on the ever increasing balance. You're being paid a return on.
Right.
So it's one of the 8 wonders of the world.
Yeah.
I like. Now, here's another thing. Another couple of things to keep in mind. Are you exit strategies, and what happens, worst case scenario, is my money going to be tied up for 5 or 7 years that I can't get to it? Or are you just going to pay an early withdrawal penalty for taking it out early? Right?
Yeah.
That makes a difference. I mean, stuff happens, life happens. You might have to get your money somehow. If you're in a fund that doesn't allow you to get your money until the project is complete, then you're stuck.
Right.
If you're in a fund that never ends, an evergreen fund, more than likely you're going to have a early withdrawal penalty for taking it out early, but at least you can get to your money.
Yeah, and it may be like ours, I think, is a 2-year commitment. Some do 3 years, some just do 1, and the thing is that all that we're talking about, and there's no right or wrong.
Yeah, it's just depending on where you are.
It's what works for you and what you have in mind for your financial future.
And I know we're getting close to the end of time here. Well, not the end of all
geez,
time, just
man.
the end of our time.
Women do.
But I also
This
wanted,
new government.
I also wanted to just slightly skim the top of your return. Is it based on actual income that's being received, or is it based on a future value?
Mm-hmm. Yeah, and that depends on what you're in.
Right.
So
So typically, if you're in a property type of a fund,
it's
part of your return is based on a future value.
Mhm.
And all we have to do is look at COVID. If you were in commercial properties that were hospitality, that future value is not what you thought it was going to be
Yeah.
when you started.
Any kind of buildings that had to do with sales, retail sales, that was rough too.
Yeah, office buildings, everything got reevaluated.
Mm-hmm.
That had to do with if it was in a lockdown and you weren't using it, they were being reevaluated. Now, in any other time, they're probably sure bets.
Mm-hmm.
But is it safer to be in something that is there's no guarantee of your return,
That's why you
but
need
it's
to diversify.
income
Mhm.
over time, or is it going to be something that's truly based on what the value of that property is going to be?
Right.
and what could help you make your determination is using IRR to figure that out. How fast you're gonna get your capital back.
Yeah.
And
So talk
Jonathan
about
will
that,
be doing a webinar on the same
Yeah.
thing.
Yeah.
The first Wednesday in November. We will
Yeah.
give you a link as soon as we have one.
Yeah. It'll
So-
be good.
I mean, one of the things when you're evaluating is at what point are you most likely able to get your capital back?
Mhm.
And the sooner you are able to get your capital back, and that once that capital is back and then it switches to cash flow, that is a more favorable vehicle to be in than one that takes longer to get your capital back and then that conversion to cash flow. So, you can look at things and probably know off the top of your head, but you can actually quantify it with an IRR function and say, okay, this one is a X, 50, this one a 50%, this is a 24%. The difference between the two would be, more than likely that you're getting your capital back in 2 years as opposed to 4. So, 2 years is probably more favorable than 4. And then you have to say, well, what are those two vehicles invested in?
Right.
Is this 4-year, secured by assets that will probably not change over time in value? And is this one secured by assets that have historically fluctuated up and down? Well, getting your money back on this one may not outweigh the security of the other one.
That's right.
So,
That's right.
yeah,
Especially if you're getting that one back on the downside.
because you don't know. I mean, because
Yeah.
it fluctuates. So it's just it's a fun way to evaluate your deals, and you can take that and then you can put it into your portfolio. And let's just say you have 20 different investments, and then you have a weighted average coupon, which is basically your weighted average yield. What is the yield that you're getting from each asset? And then you plug this new one in, and does it increase or decrease that weighted average coupon? If it increases it, then potentially it's something you would like to add into your portfolio. If it decreases it, then you have to make the determination. Is the perceived risk or perceived safety of that asset worth the diminishing weighted average coupon? So it's
Yeah, and again,
Simple.
You go back to time. Let me say it again.
You sound like
How
a car
long do
starter.
you have to recover if things do go bad?
Yep,
So
exactly.
the younger you are, the more time you have, obviously.
That's right.
Um,
We're
so
living
yeah.
on the edge, aren't we, though, Bill?
Well, we are living on the edge because we're past our time.
Yeah. Okay. Sorry.
Well, that and more throughout the month to keep you right on the edge of your seat.
And we're gonna have pictures too and stuff, right?
Yeah.
Excel spreadsheets, things to look at.
it's going to be totally whack.
I love it.
Yes, HD photography of spreadsheet.
Yeah.
All right, listen, you guys have a great rest of your week. It was a pleasure not seeing you, but it was a pleasure seeing you.
Yeah.
Thank you for joining us
Way to
on
build
the
people up, Bill.
Passive Accredited Investor Show. We are Carolina Capital Management. We are lenders for real estate investors in the Southeast. If you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, and hit the bell. Sign up for Wednesdays with Wendy, and there's also a link in there for the Wise Women Expo. So click
Check
that
it out.
on and go ahead and register for that. Have a great week. See you guys.
Thanks.